Everybody, welcome back to another episode of the Discovering Multifamily Podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Spencer Hilligoss. Did I say that right?
You got it. Yeah, on the first try.
Awesome. Yeah, sounds good. Spencer is the CEO and co-founder of Madison Investing, which is a real estate investment firm specializing in real estate syndications. He's a passive investor and an active investor, and has understood different challenges busy professionals face when starting out in their real estate journey. His mission is to arm investors with know-how with the need they make to how to make confident investment decisions tailored to their individual life goals. And prior to investing in real estate, he's had several executive roles in the financial technology industry. And for 13 years prior to that, to starting into real estate, he's also coming at us from the Bay Area, and he's been a member of the Forbes Real Estate Council and has many publications there. And today we're going to talk about we're recording this kind of mid 2022, early first quarter, and a lot going on in the market. So different cycles in the market as well, including real estate cycles. The topic we're going to talk about is how to play financial offense versus defense, and kind of what does FIRE really mean? We hear a lot about FIRE, and some people have what they call a freedom number, and once they hit the number, they kind of get a little bit lost, or they're not any happier, or they just hit their freedom number and they don't really know what to do or how to maintain that freedom number or grow that. So we're going to talk about those two topics. So Spencer, thanks for coming on.
Yeah, these are fun topics. And thanks so much for having me on, Anthony. I really appreciate it. Excited to be here.
Definitely. So talk to us a little bit about your background with, all the technology roles that you've had, and then how did that pivot into real estate for you? And, what does FIRE really mean for you?
Yeah. And again, thanks. I appreciate the kind intro, and I'm excited to be here and talk about the topic that's just inherently fun for me to talk about. And I feel very fortunate to wake up every day now and basically spend all my professional time on. I'm based out here in Alameda, California. It's kind of a little island right between San Francisco and Oakland, for those that don't know the area. Actually grew up in a real estate household. I used to be pretty embarrassed to share that for some reason. I guess it's not as cool to tell your friends growing up in the Bay Area, where everyone else is joining tech companies and doing that track, to tell them, hey, I work for my dad's, brokerage business, and I have to go clean out this fridge for a home he's preparing, or I have to go run an open house this weekend. Sorry, guys, I can't go see that concert with you. So truth be told, I actually started in real estate, I guess, at the age of 6. I don't think that's necessarily meaningful experience, but from that, flash forward to now, I run Madison Investing along with my co-founder and COO, Jennifer Morimoto. She's also my wife. And so we run this lean distributed team, and it's just a joy to wake up every day and spend time on this, because really we never planned to be sitting here. We had 13-year careers, totally separate. Mine was in tech, as you mentioned, Anthony. I had five in a row, fintech companies that I stumbled my way into. And I never thought I'd be in, number one, leadership roles of any type. And number two, really anything financially related. I didn't wake up one day when I was young and say, I want to go work on anything finance related. I didn't find it that interesting. I used to play in punk rock and metal bands. That's why I've got all these darn tattoos. And, I was interested in different things. But now here, we focus on basically sifting through all the incredible noise, of which now there's more than ever, as you mentioned, kind of coming into our conversation today, and finding out where do we park capital in ways that can actually grow as hedges against inflation, ways that it can actually grow in compelling, velocities that's ideally better than the typical equities markets. We did all that stuff. We did the big 401ks. We dumped money into that stuff. And I walked away from a very well-paying W-2 leadership job in tech companies about 5 months before the global pandemic that is COVID. And that was in, about October of 2019. So I've been building Madison Investing nights and weekends, early mornings for about 2 years, while going in and leading teams during the day. Oh my gosh. I was waking up from 4 a.m., literally 4 a.m. to 6 a.m. That was my let's go build this company time. And I devour podcasts. I listened to, 400 plus podcasts, I think, or something in 18 months, much like the one we're on right now. And read way too many books, more than I needed, something like 24 books. And last thing I do want to mention, though, it's just important background, I think, for folks is that, I look at where we are now with this very flexible, wonderful lifestyle. I have two young kids, 8 and 4, both boys, and I get to be more present for them. But all the fuel and the why behind what got me up in the morning at 4 a.m., for 2 years, and what fuels me now, that actually came from some really tough moments in my personal life when my dad's business imploded following, the death of my brother when he was a teenager. And I won't go TMI on people. I'll just say that if you peel back the story for anyone out there that you look up to, and for me, there's so many folks that I look at as mentors and role models for what I want to be like, there's usually a more pressing why for them. And for me, I just remember, taking these nuggets away from my dad's business and in my journey growing up from this dark decade that I had in that upbringing, and watching my dad's business implode following the death of his child, and then a divorce, and then yada, yada, yada. Like all that stuff happened. And it really left a mark on me to the point where it changed how I want to be a dad and a entrepreneur in our own family, and I think that those lessons really fuel me today. And I know we don't have a ton of time, but I'll just say, I think that those are the types of topics in the big why that most folks should try to dig into for their own circumstances if they haven't quite found it yet. Because you're going to need that fuel. You're going to need, like, whether you're a passive investor and you want more motivation to underwrite more deals, or you're an active investor who wants to go and try to compete in this crazy market. It's all comes back to what's your reason?
Sure. Yeah. You have to have a why in order to become, what your definition would be of financially independent and what your goals are. And for you, it sounds like you have multiple whys, which is, I think great. Obviously there's an overarching theme. It seems to come together for you, which is awesome. So tell us about your real estate journey. Obviously, you started out as a kid, with your father and whatnot. So, where are you today with your own investment firm? What type of investments are you working on? How are you protecting yourself, against inflation, as you mentioned? And, how are you leveraging real estate to sustain and also improve your FIRE lifestyle?
Yeah, it's easy to take this in so many directions, but I'll keep it just to some of the numbers, because I know some of the more quantitative focused folks out there like myself like that stuff. So just on the active side, since we started Madison Investing officially, we recently passed 30 transactions, 30 deals. And those are comprised of either multifamily, like large multifamily, middle market, so 150 plus units. You've also got, self-storage for about maybe 25, 30% of those deals. And those are the two asset classes we have focused on. I try to stick to what I know. And now, we look back at the market we've been experiencing for the past, 4 years, 5 years in particular, and are just grateful to have been here for this moment we've been having with the growth. Clearly it was a learning lesson for a lot of us with the COVID kickoff back in March and April of 2020, but that's what we've done now is largely commercial real estate value add strategies, a little more open now to development just because of the market context. But Madison Investing is really just an investment group, and we're not trying to go out and have this massive footprint. We don't even do paid marketing at this point. It's all referral based from happy investors that want to go into deals alongside us as LP investors. So that all kicked off because I was looking for a better place to put our own capital when I was still working full time and building and leading teams in the tech world. So these days, still very much look for a lot of the same fundamentals that folks probably like yourself and others in the business are looking for. We're looking for job growth, job supply, strong employment centers, the places in primarily, Sun Belt across the United States, from Texas stretching all the way down and around up through the Carolinas. In the most recent, 12 to 18 months, focused a lot more on looking west, closer to my neck of the woods. So we've been looking more so in Idaho, Colorado, Arizona. And that's that's treated us well. I think that COVID helped, drive a lot of folks in my neck of the woods in California into some of these markets a bit more accelerated than everyone expected. But that's really the high level, very, very kind of squishy version of that thesis is, we've done about 30 plus deals now there across those two asset classes. And that followed after a phase years ago where we did go out and build a portfolio of turnkey properties leading up to this point. We didn't do that many by some folks that go into the hundreds of single family homes before they decide to make that leapfrog over to multifamily. We actually got to six residential properties before we realized, it was just more hands-on management, even with property management, than we expected. And so we had, I think, 5 turnkeys out in Kansas City, Missouri. We still have a local duplex here in the Bay Area, California. That one of the first ones we bought, $430,000 for $200 a month in cash flow is not a cash flow window, Anthony, by any standard. So thank goodness for appreciation. But I would just say that that's the type of learning you get when you don't really realize the power of being able to build smart frameworks and looking for how your dollar can go further outside of your local market, particularly if you live in these pricey markets. So that's really the joy that I get to experience on a daily basis now is most people still don't really understand that these are really things out there that you can invest in. And there's ways to intelligently de-risk them. You can actually go really analyze them and pick up that one needle in the haystack, primarily with the people that you really know can pull off these business plans. Because the big de-risking of these things is the who. It's not even as much the what. Of course, the why matters, but the who is the most important part of finding these types of deals. And so that's really the whirlwind version as to working backward where we are now. And then what kind of brought us here asset class wise. I did not mention earlier, though, that what got me down the residential rental investing road was I was actually the last W-2 gig that I had was building and leading the loan origination groups at the biggest hard money lender in the country called Lending Home. We ended up doing about 600 plus individual deals per month, financing those deals. And so that was a boot camp for me on the investing world and just seeing how many zeros were on the other side of these transactions for the folks that were the investors in them. And I was like, I can't swing a hammer though. I'm not a handy guy. I use YouTube to fix things around the house. So I'm better at the other sides of the business acumen with the analysis and the partnerships and all that wonderful business leadership stuff.
Right. Yeah. No, that makes a lot of sense. So it sounds like you haven't really pivoted your investment strategy. I guess a lot of people are paying, at least right now, kind of raising cash, looking for a little bit of cyclicality in the market in terms of real estate. Although, I think it's probably going to soften a little bit, but not like the stock market. You're not going to see immediate, down. So, how are you kind of setting yourself up for, upcoming late 2022 into 2023? Obviously higher interest rates, talks of possible recession. In my opinion, probably not this year, maybe next year. So how are you kind of, pivoting yourself, like you said, de-risking your own capital as well as your investors' capital, moving forward? You mentioned some of the markets, like you mentioned, you're starting to pivot into different markets, which is a great strategy that I found too. So is there anything that I was missing from that?
No, I think you're spot on. And thank you for catching that. I think one of the biggest learnings from the past years of being in this business so far has been, hold the course whenever possible on the methods and ways that you can. It's so easy to get distracted, and it's so easy to let shiny object syndrome or whatever other platitude you want to put to it take you away from those core fundamentals, and trying to somehow tune out the unhelpful parts of the fear, uncertainty, and doubt, that just permeates so rapidly. Right now more than ever, to your point. Things such as interest rate rises, right? You and I could both attest to the fact, Anthony, that interest rate rise has been on the horizon and expected now for years. So it shouldn't be shocking. It's not shocking to you and I. It certainly it might come across as a shock though, if you'd gone back to me maybe 10, 12 years ago and you're like, hey, wow, the interest rates are about to go up. And by the way, the Fed just bumped it, half a point. And I'd go, wow, that's crazy. Oh, wow, are things okay? And it's like, well, yeah, we have known that these are coming. I do think that there's always going to be elements of the macro geopolitical landscape that no one knows. No one knew COVID was coming years ago. No one knew the current tensions with Ukraine and Russia were going to be happening this exact way. But what we do know, I forget the brilliant economist that I heard who said this, but it was so helpful when I heard this about 6-7 years ago. And it was about the fact that every cycle will come and go, like it'll up and down, et cetera. But recessions don't just happen. Recessions happen because of a trigger event. And, a good example, in March and April 2020, I think enough economists consider that to be an actual recession, albeit it was only 2 months, technically. So what was the trigger event? Well, we all know. However, 2008, without going further down this rabbit hole diatribe, I'll just say that was about, residential lending standards and debt structuring. So what will bring about the bigger, if there is a bigger quote unquote recession coming of any type, and how do you prepare for it? I think that it could be anything. It could be the geopolitical tensions. It could be all of those things, but it's not just going to happen. Like there's going to be some out of the blue recession event. So that's the first comment. The second comment would just be holding to fundamentals and how we prepare for these upcoming months, quarters, and years is really truly just like sticking to those fundamentals, but also baking in, like doubling down and baking in a couple of things that we've already been doing, such as like making sure conservative underwriting isn't just a marketing platitude that's slapped on every investment summary and offering memorandum in the entire country without any meaning. It actually has to show up in things such as rent growth assumptions. It actually has to show up, particularly in terms of sensitivity analyses for interest rates. Interest rate caps are pretty expensive right now. And I do think that like there's certain ways you could still figure that out, but just pass on the deals more often. Some of this basic stuff. And if you can't really make the deal work, if interest rates have bumped, then you got to walk away. And so, I wish I had more of a silver bullet, but oftentimes it's just the simpler answer here is like, say yes less often, and then just be stringent about your underwriting standards. That's about it. That's all I know.
Yeah, and I kind of like what you said. And I think I forget what economist, or maybe it was another Nobel laureate that said this, but in terms of recessions, it's, good times never last, but also bad times never last. So, like you said, preparing for, different cyclicalities in the market is smart, but sticking to your principles is key too, regardless of the market. So I really like what you said about that. I know you got to run soon, but I wanted to ask you about your experience in the Warped Tour. You mentioned you were in a band, so you played on guitar and in San Francisco.
Yeah, it wasn't doing the whole big tour, but it was our moment of glory for a small local bar band and small venue band, and so I look back very fondly on that. It's not very often that you go from like by day working in a buttoned up corporate job and then going and performing in front of hundreds of people and somehow, making sure you take it seriously enough. And also I was sweating bullets. I mean, that was intimidating, I'm an introvert by default, but that was that was the crescendo of a very short musical professional career. But what do they say? That as long as you make $1, you're technically a professional. So that was it.
There you go. That's awesome. How can my audience find you, Spencer?
Yeah, and I agree. This has been awesome. Thank you so much, Anthony. So we have a website. It's madisoninvesting.com, and folks can actually just go there and sign up for a call just to network with me if they want to. We are only accepting accredited investors at this time, but yeah, please do reach out.
Awesome. And we'll have a link to Spencer's website in our social media description, as well as on our iTunes description. And if you liked what you heard and or saw today, please give us a rating and review on iTunes. It would help Spencer and myself get our message out to a greater audience. So we really appreciate that. And thanks for coming on again, Spencer, and look forward to staying in touch.
Yeah, likewise, Anthony. This has been fun. Thank you so much for having me.
Take care.